Welcome. Let's take a look at problem 14-5, in which we're going to work on bond discount amortization using the effective interest rate method. Let's first read the problem and see what information has been presented, and then we'll see how to set up the problem. So we are told that Sanford Company sells $500,000 10% bonds on March 1st, 2017. The bonds pay interest on September 1st and March 1st. The due date of the bonds is September 1st, 2020. The bonds yield 12%. The company closes its books on December 31st. They're asking us to give entries through December 31st, 2018. When we read through the instructions, we are told to prepare all the relevant journal entries from the time of sale until the date indicated, which is December 31st, 2018. To use the effective interest rate method for discount amortization, they want us to construct the tables, and they tell us that we need to amortize the discount on interest dates and year end. Assume that there are no reversing entries made. So the only problem or the complication in this particular problem is the fact that your year end doesn't coincide with when the interest is paid. So let's start with pulling out all the relevant information for the problem, and then we'll work our way through the problem. So to start with, always in these problems, I need the bond face value. That's 500,000. That number was easy. I got that right off the bat there. Second is I need to know the bond interest rate and the market interest rate. So in this exercise, we are told that the bond interest rate is 10%. The bonds yield 12%, which means that's a market rate. So I got my 10 and 12% respectively over there for bond and market rate. The next two things I need is two pieces of information I need is the life of the bonds and the interest payments when they are made. Life of the bond, if you look at the date of issue and the date it is going to be due, the life turns out to be 3.5 years. Seems rather odd, but don't worry about that. We'll solve that problem in a second. How often is interest paid? Unless mentioned otherwise, it would be annual, but here we are told it's going to be paid on September 1st and March 1st each year, which means it's semi-annual interest payments. So the minute you see that interest is paid more frequently than once a year, we need to make adjustments. What do we adjust? The interest rates and the total number of payments. We have to adjust the life to what the payments are going to be. Since it's semi-annual, the interest rates have to be divided by 2. So that works out to 5 and 6%. And the number of payments over the life of the bonds is going to be 7 times. Now, these are the pieces of information I will need to calculate the bond issue price. That's the first journal entry that will have to be done. So let's first calculate the bond issue price. I need to find out the present value of a single sum, that's the principal. Present value of a series of cash flows, that's the interest payment. How often is interest going to be paid? Let me put this in a different color here. Interest is going to be paid 7 times. Each time the interest will be 500,000 times 5%. So that works out to $25,000, 500,000 times 5%. So I'm going to look up the discount factors, table 6.2 and 6.4, present value of a single sum and present value of an ordinary annuity. I'm going to look up for 6%, and the number of periods I'm concerned with is 7 periods. So when I look up the factors in these tables, I find these numbers. I bring those over here into my calculation. The last step of calculating the bond issue price is easy. We've brought all the relevant information in over here. So you just multiply the dollar amount with the factor that you pulled out from the two tables, and then add the two numbers, and we have our bond issue price. Okay. So now that I have my bond issue price, that is going to be my starting point for my schedule, the amortization schedule. I have my amortization schedule set up over here. So let me show you what it looks like. First column I'm going to enter is the dates. The date of issue is March 1st, 2017. Interest is paid on September 1st and March 1st each year moving forward. Now you will see that unlike what I usually do, in this table I have extra space over here. I've done that to correspond with the journal entry, so don't worry, there's no other information over here in this first plot that we see over here. On March 1st, the bonds were issued for $472,089.50. I'm leaving the number as is with a display of 2 decimal places. As I'm using Excel, always be careful in seeing what instructions you have been given in a problem, whether you should round up to the nearest dollar, keep it to 2 or 3 decimal places, etc. So now I'm ready to set up my first journal entry. The first journal entry is on March 1st, 2017, when the bonds were issued. On this date, my journal entry is going to start out with, I'm going to start out with this $500,000. I have incurred a liability. I have borrowed money, which means I'll have to repay the money. The amount I'm going to repay eventually, that's at the end of 3.5 years, is $500,000. When I issued the bonds, I did not get $500,000. What I got was less than $500,000, and that amount is going to be the cash debit. So if you see over here, the bond issue price is what comes into the journal entry, and that's a starting point for the carrying value. So it's very important you have this number correct. I got less than what I wanted, so the amount that I'm going to debit for that difference is called the bond discount. The objective of the amortization schedule is to amortize this bond discount over the life of the bonds. So now that I have my first journal entry, I'm going to move down over here and look at my schedule. The first interest payment, this is going to be very easy. Cash that I'm paying, we already know it's $25,000. And in fact, that's the same amount every time. It's not going to change. So that $25,000, I can write it all the way through. Now comes the amortization, how I'm going to work through with this. In the effective interest rate method, I take the previous carrying value, multiply it by the market interest rate, which we decided is 6%. The interest rate was 12%, but we adjusted for number of interest payments and set it 6%. So the previous carrying value times 6% is going to be the interest expense. The difference between interest expense and cash paid is going to be the amortization. Previous carrying value plus the bond discount amortized is going to give you the new carrying value. Remember, in this last column, the carrying value eventually has to get to become the same as a face value. Face value is 500,000, so I need to keep adding in order to bring it there. I can also show you in the journal entry how we would set that up. On September 1st, 2017, I know how much cash I'm paying. So cash credit, 25,000. Bond interest expense debit, that's a number I calculated over here. And if you see you're short on the credit side, bond discount is going to get credited. Also remember, bond discount was debited to create it. So to amortize it, which means writing it off, I need to credit the account. So the numbers that we used all came from here. So every number you have in these 3 columns are going to be used in your journal entries. Now let's see what happens for the next line and how it's going to be different from the previous one. The cash paid is always 25,000. That's not going to change. Previous carrying value times 6% is the bond interest expense. And you will see it's slightly larger because the carrying value increased. The difference between these two is amortization added to the previous carrying value. That's going to be your new carrying value. I'm going to complete the schedule. In my case, since I'm using Excel, I'm going to copy down the formulas. Otherwise, it's fairly mechanical. Once you get this first 2 lines started, doing the rest is easy. So I recommend go ahead and complete the schedule. I also added up all the amortizations to see if it comes as close as possible to this bond discount number, and it does. It's within $2, so we are good. The goal of the schedule was to amortize a bond discount. Okay, now let's focus on our journal entry over here. The journal entry for September 1st corresponded with what we had in the schedule, all the numbers, because it was completely within the calendar year, the fiscal year. Now I'm going to do my entry on December 31st, 2017. I can't do the entry for these amounts because these three amounts represent 6 months. I'm doing a journal entry before 6 months is completed. The reason I'm doing this entry, it's an accrual entry that I need to do in my books. So how many months have gone by? How much interest has accrued? September 1st through December 31st. I have all of September, October, November, December, 4 months. So I need to do the journal entry for 4 months. On March 1st, 2018, I'll do the journal entry for 2 months. So here's how I'm going to show you how the easiest way to set up this problem. I'm splitting the bond interest expense between 2 journal entries. So this dollar amount that I have over here, I'm going to multiply it by 4/6 and put that number over here. The remaining 2/6 is going to come over here. Again, the denominator is 6 because this is 6 months of interest. Here I'm saying 4/6 because 4 months have passed. Here the remaining 2 months have passed, January and February. So it's a simple calculation. It's an allocation of 4/6 and 2/6. Okay, so that is fairly easy. So I'm going to highlight this number over here. And now I'm going to use different colors all the way through so you know where these numbers came from. Bond interest expense, 4/6 and 2/6. The next I'm going to look at is bond discount. Bond discount, I do the same thing. This number is going to be 4/6 and 2/6. That's how I'm going to allocate it. The credit side. Okay. So same thing over here. So the bond interest expense, 4/6 and 2/6. Amortization of discount, 4/6 and 2/6. Now the question is, on December 31st, am I paying cash as we're done over here on September 1st? The answer is no, I'm not paying cash today. I'm going to pay cash on March 31st, not December 31st. On March 1st, I'm sorry, of next year, not December 31st of the current year. So on this day, I don't credit cash. What I credit is bond interest payable. So it's either the balancing figure in the journal entry, or again, you can take 4/6 of this number. Either way, let's take 4/6 of that number. Running out of colors here. Okay. Okay, so now the question is, on March 1st, I'm paying cash. How much cash am I going to pay? Am I going to pay 4/6, 2/6, or the entire 25,000? Recall what I told you, the bondholders could care less about what I say in terms of what needs to be done. The entire 25,000 has to be paid here. Okay? So what we will do is this journal entry, this account that I had created, bond interest payable, that was a temporary account. I'm going to close that account down. So when you combine these two journal entries, let's see what happens. Bond interest expense, when you combine these two numbers that I have highlighted in green, that's going to work out to this number. Bond discount, I credited 4/6 and 2/6, it adds up to the same number. Cash paid adds up to this number. What happens to bond interest expense? Bond interest expense, when I combine the two journal entries, what have I done over here? bond interest expense, credit, bond interest expense, debit, that disappears from the books. That was a temporary account that I'd created. When you combine these two entries, essentially it's just these numbers that you see over here. So for now, I'm going to take out the strike through because I do need those accounts, the bond interest expense that I credited over here and that I debited over here. So I would leave bond interest expense as a balancing figure in these journal entries as you work your way through. So once again, my recommendation is when you have your table set up, you know that this amount, I need to split it into journal entries. Write both the journal entries at the same time. Do the allocation of interest expense for the two periods, the two journal entries. The discount allocated to the two journal entries. Cash has to be paid in full on the bond interest date. So the balancing figure over here is the bond interest payable. And that again becomes a balancing figure in this journal entry, and it is going to be bond interest payable. Now we've done that, move to September 1st, 2018. That's fully within 2018. So the numbers that you had here, they're just going to come through over here. No worries. Okay, so exactly what you had here, like you did over here on September 1st, same thing on this September 1st. All 6 months are within the current year, so you do the journal entry. Now, March 1st, 2019, that journal entry has to be split between those amounts have to be split between two journal entries. Now, I was asked to do only through March 1st, 2018. Okay, so I'm not going to do the next journal entry for March 1st, 2018. I'm just going to do for 2018. My journal entry over here is going to be interest expense times 46. My discount is going to be the discount that you see over here times 46, and this is going to be the balancing figure in the journal entry. So once again, what you will see over here is the problem was fairly straightforward. Pulling out the relevant information is important. Most significant piece of the relevant information is life of the bond and number of interest payments. The others are fairly straightforward. Once you see that interest payment was made 2 times a year, you need to make adjustments to the interest rates and the period we are going to use to calculate the bond issue price. To calculate the bond issue price, you're going to look at the present value of the face value, the present value of the principal, and the present value of the actual interest payments, the cash that will be paid. Look up the appropriate discount factors in table 6.2 and 6.4, which is present value of a single sum and present value of an ordinary annuity, and that's going to give you your bond issue price. The bond issue price is the number you use in the amortization schedule as a starting point. That is also the number you use in your very first journal entry when the bonds were issued. That's how much cash you're getting. That's the bond issue price, the bond selling price. Next, I would set up my amortization schedule. Note if the dates all don't fall within the year and you need to do an accrual entry, I would do the journal entry in pairs. That is December 31st and whenever the payment is made. And that makes the problem very easy as you go along. So I hope this helps in working through problem 14-5.